that entrepreneurs provide, how they view them, what we're seeing as best practices, what we're seeing as what investors don't like, what entrepreneurs do wrong, to give those of you who are experienced as investors a little bit of an insight into how other investors around the world are looking at the process. So we really look at 4 pieces of documentation that entrepreneurs or startup companies typically provide to investors. The first is the executive summary. Think of the executive summary as the CV of a company. So how many of you, I assume most of you who've either have probably run your own business, have probably hired people in your lifetime, right? So you post an opening for a position and everybody sends their CV and you interview some small portion of the people based on how good or bad their CV is. And so the executive summary for a company is about the same thing. And so we're going to go through that, and again, this is just kind of a refresher. It's the same survey we did this spring. 58 angel groups, 3,400 investors replied. And so we asked them on the same scale, 1 to 7, 1 being the best, 7 being the worst, how good are the executive summaries? How important is this executive summary, the CV that an entrepreneur provides? And what we found was this was the single most important document that investors wanted to see. 70% of investors ranked it number 1. 23% of investors ranked it number 2. So 93% of investors said on a scale of 1 to 7, 1 being the most important, that an executive summary was critical in their decision to invest in a company. Unfortunately, what they said was those executive summaries aren't very good. Only about half of them were ranked 1 or 2. So 93% important, 52% high quality. And so the biggest challenge for entrepreneurs in this market is they're not doing nearly as good telling a job of the story of their companies early in the process, but yet investors value that early story very, very highly. And so one of the things that you need to consider as an investor, well, it's 2 things you need to consider. One is, if most investors are using this as the first and most critical screening tool, maybe to spend more time evaluating the executive summaries, but alternatively, now you have a choice. Do you give more of the entrepreneurs a pass because you know they may have good businesses, they're just not good at writing this executive summary, or do you hold out for the higher quality? And this is an important consideration in your own investment evaluation. What we're finding is more and more in markets where there's lots of deal flow, investors are saying, I'm not going to bother. I'm only going to look at 10, maybe 20% of the companies who provide an executive summary for me because I don't have time. I have plenty of deal flow. When you don't have as much deal flow, you might be here and look at a wider range of companies. And then you have to remember in your evaluation process that hopefully this is just the story's not told well, not that it's a bad story. So the next thing is a business plan. Business plan is usually anywhere from 15 to 35 pages. And again, we ask these investors to rank it from a 1 to 7 scale. Interestingly, only about 30% ranked it highest. Another 25 to 27% ranked it very important. So still more than half, 1 or 2 on this scale of 1 to 7, but not nearly as much as 1 or 2 for the executive summary. What they found were business plans were even worse than the executive summary. Barely 5% of them were considered superior. So this is a big challenge as an investor. What we're finding is entrepreneurs write poor executive summaries and poor business plans, so how do I make an investment? Is it a bad business, or do they just not know how to tell the story well? The challenge is these 2 documents, the executive summary and the business plan, this is the easiest part of the process of evaluation because it doesn't require you to talk to the entrepreneur. Because those of you who are experienced as investors, the first thing the entrepreneur wants to tell you is how great their product or service is. Let me show you what I have. Give me 2 minutes and I'll convince you that I'm going to change the world. And so these 2 documents, the executive summary and the business plan, are your opportunity to think about their product or service or idea without that constant push. But we know they're not very good documents. So how do we fix that? We fix that, we actually have to listen to the entrepreneur. So what we have is 60% of investors say that the company presentation is critically important. Another 20% say it's very important. So 80% of investors are basing a significant part of their evaluation on the company's presentation, usually a 10 to 15 minute presentation, much shorter than this one, with slides like this, where the entrepreneur is talking about the story. So why is the presentation so important? What we did was we asked these investors that question, and they said something on the order of this. The executive summary, the business plan, they're like the still photograph. They're like the picture of the building and the construction site. But how do I know you can make a building? I can only evaluate that by listening to you and watching you. How do I know you can lead people, hire people? How do I know you know this marketplace, these customers? How do I know that you can code software or build prototypes? I have to see that. And so that's why the presentation becomes so important. Because the company never turns out the way the business plan looks. So it's important. But the problem is you can't see 200 presentations a year. So what happens in the process of winnowing out or thinning down the number of opportunities you'll look at is you'll start with the executive summary, and you'll probably get rid of half of the candidates. So if you have 100 entrepreneurs come to you, you'll say no to 50 of them, just based their executive summary is just so bad I can't even stand it. Then you'll look at 50 business plans, and you'll say, okay, of those 50 business plans, maybe 20% of those, maybe only 10 will pass, and I'll listen to the presentations. So now you're listening to 10 presentations out of 100 companies. This is manageable. So the reason the process works this way is this allows you to eliminate the obviously unfit businesses very quickly, 2 to 3 page executive summary. But you have to offer enough leeway, consideration, that entrepreneurs aren't good at necessarily telling their story in only 2 pages. So instead of maybe saying, I'll only take 10% of the business plans, you'll say, I'll take half. And then you'll take those business plans and say, you know what, I could take 5% of the business plans and listen to those people, but then I'll never listen to a presentation. And I'll never be able to evaluate the people, so maybe I'll take 20% of the business plans. So now out of those 100 companies, you're listening to 10 presentations. And now you can concentrate on those 10 opportunities. Again, it's an efficient use of your time as screening tools, as being able to determine and focus on those few opportunities you're going to spend a limited amount of time on in your endeavors as an angel investor. But again, the most important thing we think, based on our studies and our experience, that comes in the presentation is it's interactive. You get to understand whether this person can think on their feet. You get to evaluate whether they can lead, whether they can tell a story, whether they can convince other investors or convince strategic partners to partner with the company. This is where that photograph of the building turns into, can this person actually build it? So normally what comes after that is, let's look at the financial model. You've convinced me your idea for group buying using social media works. And so when it gets to the numbers, let's just say, boy, I'd really like to understand the numbers because that's how I run my business. Again, most angel investors own or operate businesses of their own or have been entrepreneurs in the past. But the problem is that entrepreneurs, especially young entrepreneurs, can't tell the story based on the numbers. Because they don't know how to operate a business. They've never done it before. They've never led a contract for office space or bought furniture or hired people and managed big teams and managed travel budgets and software development and capital purchases. They haven't done any of these things. So the challenge is we really would like a lot of financial information, and we really don't get it. Again, so this is a transition because now Out of those 100 investments, opportunities, 100 executive summaries, you'll look at maybe 50 business plans, you'll take 10 presentations, maybe you'll take 3 or 4 out of those 10. You'll get to the financials and start digging in. So now this is where you bring your expertise in. This is where you start to say, aha, I see where this person doesn't understand how a business operates, and I know how to fix that. I can bring in a financial controller or bookkeeper or an accountant. I can bring in somebody who's used to purchasing capital equipment. I can connect them with suppliers who will give them a fair price. And so I don't necessarily have to worry about whether or not they can evaluate those things, because that's where my expertise is going to start to apply. We surveyed investors and asked them what percentage of, for companies they already funded, what percentage of financials after 1 year looked like the business plan that they originally saw. And the answer was about 3%. 97% of financial forecasts by entrepreneurs were incorrect. So I know you may be thinking to yourself, why would I invest in any of these people then if they're 97% of the time they're wrong on the financials? Because what makes a high growth company, what would normally in a normal business cycle take 20 years, can be done in 5, is that the opportunity is there and untapped, and what your capital and your expertise does is it helps compress that time frame. But what you're also compressing is the learning curve. If any of you have been in a family business, you know you get half a decade or decade to learn all the pieces of the business. You started hearing about it at the dinner table at home. And then it evolves into working in the business, and you grow into it. And you have a decade or more of experience when you start to take over something meaningful. With an entrepreneur, that doesn't happen. You have to make that happen in order to fit that growth into the process. And so that's so what we would say to you, based on these figures, these surveys, these interviews with investors, is the following. Be strict about the process of evaluating companies. Try to stick with the discipline of executive summary first, then business plan, then presentation, then financial model. Understand that most entrepreneurs are not experienced business people, and their ability to write an executive summary or develop a financial model is limited. And that part of your task as an investor to find those great companies is to figure out not whether what's there is right, but how to fix what's there that's either what's there that's not right, or to add what's missing. And that's where your expertise as business people come in. So actually, is there an internet, was there an internet connection here? Is this computer online? Well, are we connected, first of all? I don't know. Well, there's only one way to find out. Let's find out. No. No, it's not connected. Oh, you know, I can't see the screen, so it's hard to tell. I think you opened, yeah. Can you go back? I don't know if it's connected. All right. No connections are available. That's okay. That's all right. It's not critical. Anyway, what I wanted to show you was an example from the website of a venture capital firm where they talk about how they've missed great deals because they didn't know how to do that evaluation. So the subjectivity of that. With that, I guess I would take questions on the process, what we've learned. There were some questions during the break about how to apply these types of models in this culture, in this marketplace. So yes?
You twice said that the ratings on the executive summaries and the business plans were not good. What was not good?
Not good means if this was all I had, I wouldn't invest. It means that I would reject this candidate at this point. So what we did is we followed up and asked how long should an executive summary be? And what we found is that 75% of investors would prefer a 1 or 2 page summary.
Is it not saying enough detail about the product?
No, what happens is, so right now there's a new James Bond movie, right? It's called Skyfall or whatever. So I don't know how many of you have ever seen an advert for this movie. But when you see an advert for a James Bond movie, what do you see? You see 3 things. You see impossibly good-looking people, you see cool gadgets, and you see things blowing up. They don't tell you the story of the tortured childhood of the villain or how James Bond became to be a master spy. They show you really good-looking people, really cool gadgets, and things blowing up. Why? Because they know that will get you into the theater for 2 hours. And so the job of an executive summary based on the analysis that we've done is the executive summary should do 3 things. It should show you really good-looking people, really cool gadgets, and things blowing up. It is an entry point. And so instead of trying to say everything about your company in 2 pages, you should say the 3 things that are the most compelling that will get you to the next step. So too many entrepreneurs try to say everything in 2 pages, and they use really little type and really thin margins. And investors halfway through fall asleep. What are the 3 most compelling things about the business that will get the investor to take it to the next level? Think about when you look at a CV, when you're interviewing, when you're trying to hire for a position. There's really only 2 or 3 criteria that stand out, right? And if a candidate doesn't have those, you don't call them back. It's the same thing.
Less is more.
Less is more, but what is there has to be really compelling. And they're different for every business. So somebody tells you they have a template. We don't all fit in a template. We're all individuals. We're all different, right? I asked today, this being my first visit to Saudi, can you tell where somebody is from regionally by how they do this? And the answer is yes. How they fold it back indicates where they're from, right? It's a clue. I didn't know this. Now I know this. So what are the things that say, oh, that's compelling, that's interesting, that helps me make my decision? And the problem is with a template, it assumes we're all the same. It assumes every business is the same. And so I think entrepreneurs do a disservice. They hurt themselves by trying to fit into a template rather than saying, what are the 3 most important things? So there's an evangelist, Apple Computer's first evangelist, a gentleman by the name of Guy Kawasaki. He has this phrase, 10, 20, 30. In 10 slides, in 20 minutes, in 30-point type, tell me your story. If you can't do that, you won't get funded. Because he really wants you to distill it down to those important things. This is not like looking at a 30-year-old business. Do I want to acquire a 30-year-old business? And here are all the financials, and here's the list of customers. And I can interview the customers, and I can interview the staff, and I can look at the financial statements, and I can call the company's bank, and I can make a decision based on that. This is a startup company. You're investing in the future with very little past to show for it. So you need to understand what are those things that are going to be compelling that will survive no matter what. And so those are what we found tend to drive investors' decisions. So when we look at people who've invested in something like Google, is the internet in? Is the cable in? I don't know there was somebody here.
I think so.
Okay, let's try that. Sorry. Nope, not yet. Okay, so so that's what we found, is because it's a subjective decision. So we had one investor who said it very, very well. He said there's an inverse relationship between love and due diligence. The more an investor falls in love with a company, the less due diligence they do. And so the entrepreneur's job is to get the investor to fall in love with the company, right? Or the market, or the management team. Which is it? It's different, right? If I have a great management team of serial entrepreneurs, all of whom had great exits before, I'll talk 80% about my team and 20% about everything else. If I have a medical technology that can cure cancer and nobody else can do that, I'm going to talk 80% about the technology, and it almost doesn't matter who the team is. And so the question is, what is that balance? And what we believe in talking to all these investors is that entrepreneurs tend to spend too much time trying to tell the investor everything, when it's really only 2 or 3 things that will make the investor go to the next level. So I hope that answers your question. Yes?
Some of the ideas that have been fantastic over the past years, when you think of the concept itself, it sounds really bad. I mean, when Google came out, who would have thought that we would need a better search engine? I mean, Yahoo was doing fantastic at that time. And well, again, if I was an angel investor, I would say, why are you reinventing the wheel?
Yes.
It's the same thing with the concept of Groupon. I still don't get it how successful it became. It's just, we have some people here who tried to create Groupons and UAE and just didn't get any momentum. And I was surprised, even though Turkey did one and they sold.
They sold it to Groupon.
To Groupon, yeah.
That was a great exit.
You would have a good executive summary. You have a good business. It just doesn't make any sense. And I've seen lots of these kind of investments, and it kind of makes my logic a bit. Makes me feel I can't rely on my logic when I look at these investments.
Yes. So let's spend a few minutes breaking that down. So one of the questions is, so it goes something like this. Do you take vitamin pills? You do? Every day? You try, but maybe you miss, right? If there's a disease, bird flu or something on, will you get the vaccine? More probably, but not absolutely 100%, right? If you're in incredible pain, will you take the painkiller? Every time. So one of the evaluations that a good investor friend of mine uses is it a vitamin, a vaccine, or painkiller? He likes to invest in painkillers. And so, for example, the example of Google. The example from Google is Google was never a painkiller because there were lots of other search engines out there. Alta Vista preceded Yahoo. There were search engines before Alta Vista. But what Google became was Google became a vaccine because people started to see the results were better. So it's, you're not, what?
The simplicity of Google is fantastic. The front page is simple, but one way to look for it.
Right. The thing that they understood, because they were younger than any of us, was that, in fact, Yahoo and all the others thought news needed to be pushed to people and search would be some small part of this big page. And Google said, no, search is the page. And we couldn't know that. And sometimes just luck happens. But one of the questions is vitamin, vaccine, painkiller. The other thing is what we're finding, and again, this is more anecdotal than quantitative, is that at least in the EU and the US, people are buying either arbitrage or convenience. So Groupon is an arbitrage, right? If a restaurant has a dinner that costs 200 reals, and they say, this is the way Groupon works, is that they make an offer, they say, you can get this dinner for 120 reals, but only if 500 people sign up at once and pay in advance. And then when 500 people pay in advance, what happens is Groupon keeps 20 reals and the restaurant gets 100. But for restaurants that can't fill all their seats or have bad cash flow, this is a big chunk of cash, and they have new customers. So the challenge is, that's an arbitrage, right? I can go to that restaurant for 200 reals or 120 reals. I'll buy that. So we're seeing more of that. We're also seeing more convenience-based, things like Zipcar. So I think what you find is trends in marketplace, and we're finding more and more as those trends are being driven by a generation younger than us. Yes?
If an angel group chooses to invest in a certain company, Can you please explain the term sheet standards and components in the process of negotiation investment documents?
Sure. So let me just kind of finish that question. So what we're finding more and more is that it's hard to understand what's a painkiller. But we're finding, at least in the US and the EU, that more of that is being driven by arbitrage and convenience, and it's also being driven by a younger generation. So it's hard, and that's why you're seeing a lot of US venture capital firms take a small amount of their capital and invest it in really early stage companies. They don't care if they lose the money. They want to hear from the management team. They want to acquire the information of what seems hot among the younger generation. They don't care if they lose the money in that investment. It's not a lot of money. If it works out, great, but they're going scouting, is what we call it. By investing in things, they don't care whether they make money in the investment. The market intelligence of what is the next new thing is of greater value to them. So we're seeing more of that. So back to the investment process. So the term sheet is the document. It's the offer sheet. I am offering to make an investment under these terms. So term sheets are generally anywhere from 3 to 8 pages long. They're hopefully not written by lawyers, but with the help of lawyers. And this is where you outline things. So we talked earlier about, well, how do you protect yourself from a crazy entrepreneur? Well, you have an employment contract. The employment contract allows you to fire him, but make sure he can't compete with you. And so you put in the term sheet, we will only give you the money if you sign an employment contract that has these terms in it. We will only make the investment if the board of directors is 5 people and we have 2 of the seats. We will only make the investment if we have the right to force the sale of the company under specific terms and conditions. So that's what a term sheet is. Investors are probably better off being the people who drive the term sheet, just because they have more experience than any entrepreneur generally will have. It's easier to standardize a term sheet because there are some things that investors will want every single time. You know, I will always want it as a condition that nobody may cash out. I'm not going to buy somebody else's shares. My money goes into the company. Nobody may take their money out.
How do you evaluate a company? On what basis? With assets, with the assets of the company, or how do you evaluate it?
So to a certain extent, you have to remember, again, this is much more of a developed market, first market analysis. Think of, so in the US, 600,000 companies get started every year. Only 60,000 get angel investment. Only 1,000 get venture capital. It is a buyer's market. I can wait. If I'm disciplined, I wait. So what is the value of a home? Think about a home of maybe, I don't know, 300 square meters. I don't know if that's a good amount here or a bad amount, but 300 square meters. How much does that home cost in central Riyadh? How much does this home cost in Jeddah? How much does this home cost in a smaller city? They have a different value in each location because each location is more or less desirable. But the price in each location is based on what the market will bear. So to a certain extent, it's based on, again, what the market will bear. So in the US and the EU, there's a lot of statistics gathering on valuation. Smart investors do a lot of understanding, and they share with each other what valuations are. Because I don't really care what you think Mark Zuckerberg got for a valuation. If you were in Boston, that's great. But if your company's in Jeddah, you're not getting Mark Zuckerberg's valuation. And there's a certain amount of discipline that holds to that as well. Another way that people value companies is backwards. You have to remember that even in 1998 to 2000, in the height of the internet boom, the majority of exits of venture and angel-backed companies were through acquisition. IPOs were less than 50% of the exits even in 1999. So most companies get acquired. And acquirers have a limit on what they can pay for a company. Their stock price will go down if they overpay for some acquisition. So if you work backwards from what people are, the exits and the multiples, you can also come back to an early stage valuation. Are we ready here?
Yes, sir.
Great, thank you. Internet Explorer or yes.
Now, you mentioned something related to the employment. Did you mention employment means employment within the same startup or employment with the venture capitalist? Or
No,
the-
within the same startup. So even though I'm an owner, so let's say I'm an entrepreneur and I own 100% of my company, and I come to you and say, invest in my company. And you say, okay, I will invest 2 million reals, but I want 40% of the company. So now I only own 60%, you own 40. But what you say is, I want you to have an employment, you want me to have an employment contract with the company. So even though I'm the majority owner, I can still be fired because my role as CEO is an employment role, not an ownership role. You make sure that being the CEO is an employment, it's a job that you can be replaced in regardless of how many shares you own.
But then you can come to the board and have more control over the company, unless your shares are not vested.
No, your shares can be vested, but what happens is, this is why you want a board that, remember, boards don't have to reflect the percentage ownership. So what investors often will do is say, look, I'll only invest in the term sheet if the board has 3 people. You can be one, I will be one, and we will agree on who the third person is. So now, if I'm the CEO, I own 60%, you own 40, and you and the other director say, you're fired because you're not doing a good job, that's it. So it's important to understand that who holds the job of CEO has nothing to do with how much I own, has to do with the idea of who the board selects. So you need to make sure that the founder doesn't have a majority of the board seats, which is different from having a majority of the shares.
It seems obvious that angel investors have high involvement in the company. If you are in the board, then you will articulate strategies, but you will not be able to involve in day-to-day operations.
Correct.
Is that, don't you think that angels get involved heavily in the processes and day-to-day operations?
I hope not. It depends. If you were a CEO, if you were a founder of a company in the semiconductor business, and I had 30 years of semiconductor experience, then I would expect you to involve me heavily, and I would expect to be involved heavily because my experience is exactly the same. But if you have a mobile app company, and I'm a 54-year-old guy who can barely use a phone, I shouldn't. And this is where the angel investor has to have the discipline. Do I understand the markets? Where can I help and limit their involvement only to that place where they're going to be helpful? Whether that's partnerships, mentoring, operations, sales. But if an investor is going to get in there and be part of in effect, part of the day-to-day operations, then they're part of the management team, then they're not an investor. Your job is to help the entrepreneur grow, provide resources where they're not, and get rid of them when they do poorly. But if you're going to operate, then you're not an entrepreneur, you're a co-founder, and that's different. If you want to invest in a company and be a co-founder and be part of the leadership team, that's perfectly acceptable. There are angels who absolutely do that, but they're in the minority. Most are investing to help the entrepreneur grow rather than get too deeply involved themselves. So my office in Chicago, I share with a venture capital firm. They're on their 6th fund, which only about 15% of venture capital funds in the US make it to their 6th fund. So the partners who invest in the portfolio companies, they talk to the CEOs on the phone once a week, maybe twice a week, no more than an hour. They serve on the board, go to a board meeting every month, every quarter. That's the extent of their involvement, and they put millions of dollars in the company. At that point, you're relying that the company has built up a strong management team. So I wanted to get back to your question of how do you find the next new thing? And sometimes you miss. So this is a group called Bessemer Venture Partners, and you can see that we've kind of got this rotating portfolio. You can see some of the companies. You may recognize some of the companies. But even the best investors make a mistake sometimes. So here's where the Bessemer people talk about some of the ones they missed. This is my favorite is Google. I'll read the description if you can't read it. So David Cowan is a partner at Bessemer. I had the opportunity to meet him once. So it says, David Cowan's college friend rented her garage to Sergey Brin and Larry Page for their first year. In 1999 and 2000, she tried to introduce Cowan to these two really smart Stanford students writing a search engine. Students, a search engine. In the most important moment ever for Bessemer, Cowan asked her, how can I get out of this house without going anywhere near your garage? And so they missed. But the other part of the story is that the woman who rented the garage joined the company, became employee number 5, and is now wealthier than Cowan. So sometimes you miss. Sometimes it's hard to tell. But it's important also to maintain good relations with entrepreneurs. So here's an example, FedEx. Fred Smith started FedEx. It says, incredibly, Bessemer Venture Partners passed on Federal Express 7 times. How do you get an entrepreneur to come back to you and ask for money 7 times? They maintained a good relationship with him. They had 7 other opportunities to jump in and be an investor in FedEx. You know, to your point, eBay, stamps, coins, comic books, you have to be kidding. They couldn't see it. So the idea, I think, is to just, again, you know, here's Neil Brownstein. They had the opportunity to invest in Apple when it was worth $60 million. The entire company was worth $60 million. Sometimes you miss. You can't ever get every good one. But it's important to understand that these stories have great lessons for investors. One is maintain good relationships with entrepreneurs, even if you think their idea is crazy, because sometimes they're not. They proved you wrong, and you want to get in later. Right? Don't miss an opportunity to network with somebody if it's somebody you trust. Because when you miss that opportunity, you may miss the next Google. Sometimes it's not about what the valuation is. Sometimes it's about the opportunity. Right? Market capitalization of Apple now is $600 billion. Right? So it's 10,000 times that 60 million. So sometimes it's not about the valuation, it's what the opportunity is. And so there's no one right way to do that. If they would, all venture capitalists would be successful, and we know they are not all successful. Yes?
The idea of Sirb network is to create an angel network and jumpstart the ecosystem. I have a different view on how to jumpstart the ecosystem, and I would love your input on that.
Okay.
The problem is, here in Saudi Arabia particularly, there are 2 candidates for angel investment. Either those with very deep pockets, family businesses mostly with billions of dollars, or those professionals with a few $1 million that they can spare part of it. The problem, in my opinion, is that the deep pockets, 2-3x return on investment on $100, $200, $500,000 is nothing to them. So for them to kind of support the company for a couple of years, for a few years, to make 2-3x on peanuts isn't enough of an incentive for them to go into angel investment. And those with smaller kind of liquidity, with a few $1 million to spare, to them getting into angel investment at this day and age is too risky, because there aren't enough kind of exits opportunities for them today. My belief is that the best way to, and I would love to see if you have some international perspective on how to get all of this. But my point of view in this is that this could be easily solved by kind of zooming in, whether this is by enterprises or by individuals or by private or kind of leading investors or whatever, but zooming in on a few kind of high potential startups, doing the impossible to make them success, shed the spotlight on them, and make them heroes, and this will just pull everything in the ecosystem together. And we've seen it in Saudi Arabia. A few people made millions in the stock market, and all of a sudden the stock market boomed. A few people made money in real estate, and everything went up. And that's my perspective on that.
Yes. Okay. So I'm going to answer both of those questions in series. So first of all, the question about the really wealthy people for whom this is pocket change, right? Like I might have 10 euros in my pocket. That's how they view 500,000 euros, right? Those types of people, it won't make a difference if they triple their money on 500,000 euros. So what we've seen in some markets is, and remember, I think my third or fourth slide where it said make a little money, do a little good, have a little fun. We've seen where what happens is a group of angel investors will go to people like this and say, look, this is not important money for you, but it's important money for the community. We'd like you to do some good. But we know this is beneath your review. So, but you don't want to just give your money away. So if we invest, we would like you to co-invest with us. So you create a co-investment fund among the mega wealthy and ask them to each put in, I don't know, 5 million reals or something like that. And then you have a 75 million real fund that doubles each angel investment. So they understand it's not charity. They understand other people are taking the same risk they're taking. But they're not doing it because they want to make the investment so much as they're willing to invest in the growth of the economy. So a co-investment fund is one option that we've seen work in some communities. To your second question, the problem is what we call the hourglass problem. If you think of an hourglass, right, all the grains of sand have to go through that little pinch hole, right? And if it clogs, nothing gets through. So the challenge with what you're talking about is what happens when one group of 5 people decides who the winners and losers are going to be. If those 5 people aren't superior, then nothing gets to the bottom of the hourglass. So, for example, if you were going to go in rush hour to Riyadh Airport, right? How many different ways can you get to the airport? Would you go with somebody who only knows one if you're running late? Or would you rather go with somebody who knows 3 or 4 different ways? A shortcut, a back road, because you need to get there on time. So concentrating that in one team, you have to be absolutely certain that team is superior because you're running a risk. You'd rather have 5 routes to the airport, not just one.
I'm sorry, I think I was misunderstood here. What I suggested was we see those tens of government programs to support entrepreneurship. We've seen lots of corporate social responsibility activities to support entrepreneurship, and they always tend to try to standardize something in an ecosystem that doesn't exist. So we want to give a ticket of this size to this many people, and if we do this, we get that, and there aren't enough leads, there aren't enough exits, there aren't enough anything. So if instead each one of those, not just one team, go and try to headhunt and find the best startups out there. And instead of giving 10 startups $100,000 each, give those 2 startups $1 million each, and help them with your relations and your network, and make them a success.
Who decides the 2?
Who make an impact in the industry?
But my point is, who chooses which 2? If 10 groups come up and say, I have a candidate. If each of you in this room had a candidate, who would decide which 2 get it? Is this like Shark Tank or whatever the, who decides? You're as good as those 2 people, those people who decide the 2.
People who would decide to give the money to 10 people or to 20 people, they're going to decide anyways. So if they just kind of focus the effort a little bit.
Yeah, and I understand what you're saying, because if you give 10 people 1 meal, everybody's still hungry. If you give 1 person 10 meals, that person may make it. I understand that, and there's value in that. But maybe the problem is, and maybe I'll get into trouble, and hopefully my visa won't be revoked, but maybe the idea is it's time to give 10 meals to 10 people. And that's the answer, not 1 meal to 10 people or 10 meals to 2 people, but to have the courage to give 10 meals to 10 people. So if my visa gets revoked, Hisham, it was my fault, okay? But it's a serious risk. But the problem is when you work for a government, and we face this in the US, States compete within the United States all the time for startups and for capital and for focus. You know, one of the big games in the United States is a big company that says, well, I think I might leave Chicago, and then 10 states come in with this incentive package. If you move here, we'll give you tax breaks, and we'll subsidize the move, and you won't have to pay property taxes, and they all bid, and the company just sits there and waits for somebody to make them the most lucrative offer. In the United States, nothing was gained. So when Boeing Company moved from Seattle to Chicago, Chicago won, Seattle lost, the United States net zero, right? So it depends on the level in which you look. So the challenge with people in our government is they will never get a big promotion if this program like this works. They won't get a 200% bonus in their salary. They won't be promoted 3 levels because it's the government. Somebody will say thank you very much and then go away. But if it fails, they will get yelled at and they will get demoted and they will get put in some remote outpost. So there's no benefit for taking the risk, but there's plenty of penalty if it fails. And so, at least in the US, that challenge has been hard to break. So, you know, I don't know to the extent to which it exists here, and I don't want to comment on that because, again, I would like to come back, and I've enjoyed everybody I've met here. But, sure.
From your experience in the U.S., how did the government contribute to jump-starting certain ecosystems? I know, for example, Tim Draper was quoted saying that his first fund was 6-to-1 funded by government. So for every dollar they took as a private sector, the government put $6 in the fund. So is there any kind of similar stimulus programs or something that helped that? Given your long experience, that helped this industry, say at the late 90s or at the early 90s when it was just starting, not now?
So that program in the US was called SBIC, Small Business Investment Company. And so if you raised amount of capital, the government would leverage it and give you an amount of capital so your fund could be bigger. The government discontinued that program because for every Draper Fisher or whomever, there were 5 people who didn't make it. And in the end, the bureaucrats got yelled at because so much of the money was lost. Because what happened was when they gave away that leverage, they didn't, that didn't offset the number that failed because there was no financial return to the government. So the bureaucrats had to cut off the program because they got yelled at by the politicians. So that program actually has had limited benefit. It's been discontinued, and now it's trying to come back in a modified form because of that. People forget that both Boston and Silicon Valley had minimal government assistance.
Okay, I just want to add to what Mr. Rashid mentioned. Does the government play a role in setting up and establishing a group of angels in the U.S.?
It varies by country. So for example, in Canada they're very supportive of angel groups. And there is funding. If you start an angel group, you can get up to 100,000 Canadian funding to cover the cost of starting and organizing an angel group. They have an annual conference of all of the angel groups. I went to speak at it this year. The government subsidized, paid for my whole trip. It's called NACO, National Angel Capital Organization. In the US, the Angel Capital Association, government gives us nothing. Everybody goes on their own, at their own expense, and we don't see anything. So it varies. The amount of government support varies by country. The Canadian model, I think, has worked pretty well because there are cities like Calgary and Winnipeg in the oil sands and in the shale oil areas where the extraction economy is similar, that now have angel investment, now have entrepreneurs going there because the people who made their mineral wealth, they were encouraged to become angel investors because the government actively supported that. So I think the Canadian model is very interesting. There have been a couple of other models. Indonesia right now is playing with a small program where they are supporting the formation of angel investor networks and more sources of capital for entrepreneurs. It's not as broad as the Canadian program, but it seems to work. In the US, the biggest incentive is a tax incentive. If I make an angel investment, it's at the state level, not at the federal level. So if I live in the state of Illinois, Chicago is in the state of Illinois, if I invest in an Illinois startup, I get a tax credit on my income taxes. Your tax system, personal tax system, is very, very different here. That wouldn't work here. So there are different things that are done in different areas. But I would say that, my guess is that the best match of the ones I've seen would be the Canadian model for here. Yes?
Actually, I am interested about the group of investor. Today we are doing a solo investment as a businessman. And if you can elaborate more on an example of either organized group of angel investor or non-organized group of investor, how many people normally in each group, what is their capital they share in the group like this, if you can just...
Sure. So of the 375 angel groups in the US, the typical angel group, the average is about 43 investors. They don't reveal to each other their personal capital. So we don't know how much capital they have total, because that's a private matter. How much am I worth? How much are you worth? What we find is that these groups invest in 6 to 8 companies a year, putting in US somewhere between $1.4 and $2 million each. So if you have 375 groups and each is doing 6 to 8 investments, what you're finding is you're finding that it ends up being about 8 to 10% of total angel activity in the United States. No. No. So what happens is, let's say there are 40, let's say we were all a group, or you were all a group and I was the entrepreneur, and I made my presentation to you. What would happen after that presentation is you'd ask me to leave the room, and the leader of the group would come in and say, okay, who is interested in this company? And maybe only 6 of you raise your hand. And the 6 of you will do the due diligence and offer the term sheet, and the 6 of you will invest. And you won't all invest the same amount. One of you might invest 300,000 reals. One of you might only invest 150,000 reals. One might invest 500,000 reals. And you will each own different portions of the company, different stakes in the company, based on how much money you put in. So it's an individual decision. You work together with each other to do the due diligence, to do the term sheet correctly, to make sure the workload is distributed, to rely on your collective experience and knowledge. But your investment decision is yours and yours alone, and the amount you put in each investment is your decision and only your decision. Now, there are groups where that's different. I described before that I manage an angel fund. In the angel fund, we had 11 people. And we decided that we would have a rule which we called majority plus 1. So 11, 6 is the majority, 5 is the minority, right? So we said majority plus 1. So we decided that if 7 people said yes, all 11 had to write a check. And all 11 would write a check for exactly the same amount. And the reason we did that was we knew we would never get 11 people to agree on anything. But we wanted people to put their capital into entrepreneurs. So we said that we would have this group vote, majority plus 1, and so that everybody was equal, everybody had to write the same check. But the majority model is individual decision for an individual amount. Does that answer that question? So then the 6 will choose among themselves. It may not be the one with the most money in, but it could be. So let's say you had 300,000 in, you had 150,000 in, and you had 200,000 in. You had 300,000 in, you could say, I want to be on the board, but if he has the most industry expertise, shouldn't he be on the board, even if he's not the largest investor? You decide what's right to make the value of your investment go up. It shouldn't be just by the right of how much money I put in. It should be who can make the company the most successful. And, so that's who you should select to be your board member. Or you could rotate. If you think it's not fair, then you say, okay, first year you'll be in, then you, then you. There are different ways to do it. But in any case, you really want the person who can add the most value to be on the board.
So it is not, they didn't form a company, they did not collect, they put the money together in a bank and become a formal business. It's like
The
everyone.
only people who like that are lawyers.
Ah.
No, I mean, you can, but it depends on the tax system. So some people in the US do. If you have a lot of people investing a small amount, like if you have 10 people each investing US 25,000, then you would form one of those because the company doesn't want to have to deal with 10 investors. So you might form one of those for convenience for that sake. But in the US, there's expenses associated with that. So we find the model that most investors use is I invest directly and I'm the owner of the shares. I don't have an intermediate entity. If I decide that the company's not going anywhere and I want to write off my investment and Hisham decides that no, it is, you can take different paths once the investment's made because you're not linked. Yes?
My question is about maturity of the players in the ecosystem. My understanding of what's happening in more mature markets like the US is that there are a lot of unwritten rules of code of conduct in a way within the industry. So an angel investor could take advantage of an entrepreneur and take more equity, but if they do so, then no VC will invest in that company because that angel investor have too much equity in it.
Yes.
A VC will not dilute the angel investor because then they would kind of lose future deals that come from that angel investor. So all those kind of unwritten rules could take years for them to kind of be established. Like we have, for example, lots of very kind of well-known unwritten rules when it comes to real estate industry here, and how to split a commission and how to do stuff, and everyone knows them because it's a mature industry. But when we talk about investment ecosystem, is there a way to accelerate this maturity as opposed to let it build with enough exits and enough VCs and with enough mature players that enforce it?
So this is why the Angel Resource Institute exists. We exist to take those unwritten rules, write them down, and tell people about them. So for example, in the US, if you're an investor and you hurt an entrepreneur, the entrepreneur can go here to a site called The Funded and say what they want. So if I want to see what happens at Sequoia, no, I don't want autocomplete. Okay? Not only do I get ranked by everybody who ever talked to them, individual partners get ranked. So if I'm a jerk, hundreds of entrepreneurs find out within minutes. But so the Angel Resource Institute seriously exists to try to write down those unwritten rules, put data around them, and then let everybody know. That's what we hope to do. But the marketplace in developed markets like the US, they come up with stuff like this. An entrepreneur was really upset at how he was treated by a VC, created this, told everybody he knows. Now, hundreds of entrepreneurs, mostly in Silicon Valley and Boston and New York, use this. But if I ever want to find out about a venture capital firm, I go straight here. I want to know what somebody's saying about Greg McAdoo, right? Or David Spector is a fair guy. It's good to know, right?
There is no one for angel investors? This is only for VCs?
This is only for VCs. So in the US, for angels, probably the closest thing is this, Angel List. So AngelList is a group of angel investors who've gotten together, and they do parts of that. It's more collaborative. It's less, this person's bad, this person's good, but there are aspects of it within AngelList, and that also exists as well. So I don't know how much more time we have, or how, since I'm the person between everybody and dinner.
Let's ask a question.
Okay. I would just like to add one part of this. We are in the final stages of signing a contract with Angel Resource Institute to help us designing and building the structure of Sirb network, and with all these details and probably the wishes that you have just shared with us to be within our structure, inshallah.
Yeah, so what we hope to do over the next year or 18 months is take a lot of these unwritten rules, a lot of the data we've collected, and bring it here, as well as to develop ways to figure out how to use that data to create a unique set of best practices here in Saudi.
So that's our goal over the time.
Okay, if I may ask one more question.
Of course.
Again, it's about somewhat of maturity. And my question is not how to evaluate a startup, but how to help the ecosystem evaluate or evaluate the contribution of different players. So let me give you an example. Here, for example, if an angel investor invested X amount, they're not doing, they haven't helped the company a lot. They gave them the initial seed that is needed, they took the risk and everything. Any kind of VC that would come would not feel any problem diluting them big time, or kicking them out, or buying them out at peanuts and not making them make a lot of money, because they don't know them. There isn't enough historical information that this kind of angel investor will bring you other deals in the future, and you better have them in, and they will contribute a lot going forward to the company and stuff like this. So we have a lot of this kind of immaturity from everyone. So is it reputation? How do you measure reputation or value of a person?
So for entrepreneurs, I mean, this is a big challenge for entrepreneurs. Entrepreneurs in the US and in the EU are very scared that the investor is going to steal their idea. And for the most part, investors don't do that, mostly because it would shut off deal flow, because deal flow is significant. Where deal flow is low, then maybe people don't find out. But for example, if I was being incubated by Batter, and you did that to me, I would tell them and everybody else incubated by Batter. So I don't know, as your ecosystem grows and grows stronger, it's harder and harder to hide behavior like that. So for example, in Kansas City, there's a program called 1 million cups. The idea is that if people will network and share 1 million cups of coffee, that the network will be much more robust. So they started this with 8 people last March, I believe. So earlier this month, I went to, I guess it's the 8th meeting. They had 240 people, from 8 to 240 people in 8 months for an entrepreneurs forum that lasts 90 minutes. So I think in March, if you stole an idea from an entrepreneur, maybe nobody would find out. You do that in Kansas City in November, it will be the last deal you ever do. So I think part of that will come with the growth of the ecosystem. There are ways to protect certain parts of that. So in the US, the ecosystem is significantly developed enough where it's hard to hide that behavior. And so as a result, you don't sign non-disclosure agreements or non-compete agreements. In a market where the ecosystem is not as developed, it may make sense for entrepreneurs to ask for a non-compete or a non-disclosure agreement when revealing inside information to an investor. I don't know how that would work here. We'd be happy to work with any of you to kind of do the investigation to see whether that makes sense. But it may make sense that at least you have some legal recourse and at least people have been put on notice. But it's a difficult thing. So I think we're running late, so maybe I'll take one last question, and otherwise I believe it's time for dinner. And then I don't want to interrupt that. But unless somebody has a last question. Yes?
Yes. From the investment houses now, within, let's say, a venture capital firm, there are different groups within the venture capital firm, from scouting deals to taking the decision about investment, then to portfolio management. So do you recommend, based on your experience, that the process of managing a deal from A to Z should be accounted to one person, or it should be a group of activities within the same organization?
So the prevailing model in the US is one person does everything, from scouting to negotiating investment, to being on the board, to managing the exit and portfolio management. That's why when you go to the funded, they talk to you about specific people, because that's the person you will be dealing with during your entire life with that venture capital firm. So the US model is one person takes you from beginning to end, which is why there are listings for every individual person, because that will be your main contact. That's the prevailing model. That model works for a number of reasons. One is that knowledge transfer within a firm is always imperfect. The second reason that works is its accountability. I now have to sit with my partners and say, that deal went bad. It's my fault. I can't blame it on the portfolio management group or the deal negotiation group. It's my fault. So it's accountability in the US. So I mentioned that my firm, our PX group, we share offices with a venture capital firm. They're on their 6th fund. They have 5 investing partners, 3 administrative staff, that's it. That's the whole fund, the whole group. There's no portfolio management, there's no deal negotiation teams. The partners are responsible for everything. It's not as productive, but it's a much higher degree of accountability. And that's the prevailing model, both at the European Venture Capital Association and in the US National Venture Capital Association. So with that, I think I should wrap up because dinner is waiting. Is that right? So thank you so much for your time. I appreciate the opportunity to come to the Kingdom and do that.
Can you share the slide?
Yes. Yes, he will. If you let Hisham know where to send it, he can send it. But thank you so much again for your time, and I really appreciate you listening to me tonight.